Hello, everybody, and welcome to 2021. Welcome to Toby Wilde, who's the founder of OPARO, and he is our first in a few guests that we're going to be chatting to this week with regard to the outlook for property in 2021. A lot of forecasts were made at the beginning of 2020, and who knew the roller coaster that was going to take us on. So welcome, Toby. Thank you for taking the time. Do you just kind of want to introduce yourself, give us a little bit of insight into Proptech, and then, yeah, I'd love to hear your thoughts for this year.
Sure. I didn't realize I was the first, by the way. That's pretty ominous. I'm really nailing my flag to the pole here, aren't I? But yeah, so I'm Toby Wilde, founder of OPARO. Previously, I was one of the founding partners of a property data platform called Sprift. I come from a third generation real estate family, principally development, construction. And OPARO is was the first, it's been going a few years now, algorithm-driven real estate investment company in the UK. So we use big data technology and algorithms to flag areas and investment opportunities which we believe are safe in the long term and will show good income, good growth, forecast capital appreciation, things like that, and also flag financially stressed and distressed real estate assets prior to insolvency.
Great. And 2020 has certainly been a roller coaster. How has that been for you guys, and how do you see things kind of moving forward this year?
It's been good. Initially, COVID was a big concern because we had done a rather large transaction which would have kept us in business for another year, with all the staff being paid decent salaries, and it was really good. We were in the conveyancing period, pre-exchange, and unfortunately that fell through the first 2 weeks of COVID. It was a large hotel, so that was tough, but we picked ourselves off and focused on actually what it is that we like, which is sort of subprime real estate or affordable real estate. Through my family's 50, 60, God, more than that now, 70-year history, and throughout my whole career, it's always been about affordable houses for normal people. Never been interested in super prime or factoring in a 29% new build premium as some people in the market do. It's all affordable homes for normal people. That's what I'm all about. So that's what we focused on. We've done very well. We've got 13 transactions in legals at the moment, pre-exchange, which we're completing on all of them in the next 6 weeks. And we've got some projects started. We've increased our capital under advisory from 73 million to 122. So that was, I think that's an interesting sign of the space and what's to come, to be honest. It's going to be a really interesting year because a lot of people post-Brexit have sat on their hands and not done any transactions or not done anything. So I'm speaking to family offices and funds who are just desperate to deploy capital now. They've seen what's going on, and the market hasn't really caught up with the fundamentals of the economic norm we are now in, but there's been a massive influx of institutional family office and fund capital into the space in the last 2 quarters. Massively. I mean, we could have an increased capital advisory if we were less selective about the partners we took or their backgrounds and how good a fit we feel that they'd be to us personally, our personalities.
That's really interesting. It certainly echoes kind of the conversations that I'm having with kind of fellow high net worth individuals and family offices as well. There is cash to be deployed, as you say, and even if there's kind of headwinds for the market next year going forward, then the fact that there is that capital ready to kind of be deployed hopefully would be supportive. So what are you guys looking at? What are you guys concentrating on? What do you think the opportunities are for next year?
Well, we are, as I said, we're still focusing on normal houses and normal people, affordable homes for people, long-term investments, to be honest. We tend, on our own balance sheet, I'm talking now, the capital we represent, they have very different streams, and that's up to them. And I've got a little bit about what their investment strategies are, but principally PRS, co-living, not so much ground up developments, conversions. In London, most of our mandates are London based, But us on our own balance sheet is very much, 10, 25-year views, blocks of flats, residential houses, just affordable housing. Really, that's where we see the greatest opportunities. But again, we're taking a 10 or 25-year view. If you can take a 10-year view, then you'll never lose money.
Yeah. And it's interesting, isn't it, that you guys are kind of looking at London and the South kind of a lot. And actually, I was looking at some data that Islington was one of the kind of the real, if not the top winner of 2020, which was very interesting, when a lot of people were calling that, that London was dead, and and granted, people are kind of shifting out into the kind of more rural areas, but certainly not dead, is it?
I know Notting Hill performed very well this year, but yeah, that's not really. I like zones. I like zones 3 to 5. That's where I like. Zones 3 to 5, where you've still got infills, where you can still do a bit of ground up development if you want to, but finding land is still tough. But I think potentially we could about to bear in mind how many moth-build dev sites or developers I see showing signs of stress or distress at the moment, and there's a lot of them. I think we hopefully will finally have this post-Brexit land realignment that I've been waiting for all these years. But I think it's going to be really interesting, because matched with the institutional influx of capital into this space is I think there's going to be more hunger for PRS developments and for rented developments. So I actually think a lot of the new build developments that happen now, they'll be stabilized income and sold as asset generating entities, or effectively SPVs. Because I mean, the fact that 28-29% new build premiums, as we see, and that's why half of Wembley's gone unsold, all the developments up there. But if you factor in that into land prices, you just can't sustain it. Whereas actually, if you look at things on a stabilized compressed income to a fund, then actually I think there's going to be a lot more movement towards what us, IMO Capital, and maybe SPI with Anna as well do, where you sort of look at these stabilized income generating assets where you buy them on a compressed yield. So I actually think a lot of new builds we see now will just be unaffordable to the masses. So I mean, personally, I think we're going to still see the high transaction volumes. I think the stamp duty relief has obviously helped that. But aside from that, I think generally people are sick of all of the bullshit in the media, like rapid cycling real estate markets where your house changes value like the stock market does. The fundamentals of real estate, as you know, don't change on a knife point, as it were. Except from with COVID. But still, I think there's been too much in this country of an attitude where you buy property for investment. In reality, property is meant to be a home. So it's going to be interesting to see. I really do hope that the population en masse take the opportunity while they're still employed, and still the market's not too bad or too overinflated, to buy themselves homes. And because that should be for 10 or 25 years. So I don't know why people keep looking, oh my God, well, the market dipped 1% this month. So the market dipping 1% or going up 5% this month makes absolutely no difference to you over the 10 years, 20 years you're going to own that home. What are you even talking about? So I really hope this whole mass media property world we've been in comes to an end, because it's not good for our society in general, I don't think, personally, but there we go.
I think they're excellent points, and like you say, if you're clear on what your kind of people call it strategy, but it's business operation, isn't it? If your time horizon is long enough, then exactly the micro fluctuations of a month here or a quarter here are irrelevant. If you're flipping, it's a slightly different thing, and you have to maybe be a little bit braver on that type of stuff. But as you say, the fundamentals are the fundamentals. So
no, they really don't change. They really don't change that much. Interesting, because obviously our algorithms flag financially stressed and distressed real estate assets, and we have seen a massive increase in stress and distress. on all of the key indicators, and that's unsurprising when unemployment and insolvencies are going up so much. But they are being bailed out at the moment by the government by quantitative easing, and it's not going to last forever. So we do believe a lot of these assets we're seeing in Q3 will realign their values slightly with market realities, especially not industrial or out of town retail, which seem to be doing fairly. I think there's a lot of good opportunities there already, which means it's, you know, if you can spot an opportunity, or as Jimmy Goldsmith said, if you can spot a bandwagon, it's already too late. The fact I was seeing 6 months ago buildings or retail parks with tenants like Lidl or covenants like Lidl and Pets at Home selling at a 20% coupon or 20% yield out of London, you know, it's not going to be long before people flood into that. But office, you know, I think we might catch a cold in office. But it's interesting what you say about Islington, because I'm actually surprised Islington has fared well, because Islington, I don't think the fundamentals of, I'm not a big fan of the area personally. I don't know it that well, but my solicitor's based there. But I was, you know, places where you can get a pied-à-terre still, like Notting Hill, like your Pimlicos, like your Chelseas. I'm not surprised that they're sort of buoyant. But I don't know many people who buy a pied-à-terre in Islington, and you know, the whole move towards working from home actually means people want normal family homes and bigger houses again. Or anecdotally, estate agents are telling me that people are looking for bigger spaces and are willing to travel a little bit more. So that could be a really nice thing that's come out of COVID. Actually, our live-work balance could be better, you know.
Absolutely. I think this year has given people, or allowed people, to pause and actually think and assess where they are in their lives, what life they've created for themselves, and is that what they want kind of going forward. So yes, you're seeing people kind of move out, but you're also seeing people just kind of reassess that whole balance. So
100%. I know we haven't got long, so I can quickly rattle through my other list of
would love that. Please.
I think cash is king this year. We're already experiencing with a lot of our buyers, they're selling to us because we are able to cash flow the purchase there and then if we need to. We have a balance sheet to prove that. So that definitely helps us get built over the line. So I think, cash and quick transactions. I think we're going to move towards quicker transactions in terms of conveyancing, because vendors and buyers alike aren't willing to take these 282-day, as it was a few years ago, you know, from valuation to completion. People want to be now like, I want to exchange within 14 days and complete within 28. Let's not muck around. And it's certainly in boroughs I'm doing purchasing stuff, the searches are only taking a week or two to come back. So that has definitely helped. So I'm not sure what the government's done there. Maybe they've invested a lot into the search departments. But there's a lot more liquidity in the market in terms of turnover of stock. I think cash is going to be absolutely key to being able to purchase property. People don't even want to sell on a bridge at the moment. Forget about getting a mortgage to buy a property. It's too arduous a task. So I think that, I also think there's going to be some mergers and acquisitions within the crowdfunding space. Obviously, it's no secret that they removed half the crowdfunding licenses this year. I think crowdfunding as an industry is in real trouble. I think there'll be a couple of equity-left players left at the end of it who do the riskier stuff. So your Tushkas and Davins and your Rob Wilkinsons, you know, the Crowd With Us and Simple Crowdfunding guys. I think there'll be equity-left players. I can well see the likes of the debt side players getting acquired by banks, because secretly, behind the background, or not so secretly, it's there if you read it about it in the press, but the government has been definitely moving towards an institutionalization of real estate. That's really come to a head during COVID, because now they are talking about privatizing all the council housing stock, so selling it income generating assets again, so they could be listed effectively. And I don't think they'll do it as a REIT. I think they'll form property ISAs, because if you also notice, they scrapped the property ISA, which was meant to be for first-time buyers, and I think they vacated that just to get the name back, so that banks now will be doing securitized real estate portfolios on their own balance sheets. I mean, Nationwide have just done a big development down in Swindon. I think there'll be a launch this year of property ISAs where you invest and you get your 4% yield or your 4% annual return, and it will be literally, you'll be buying into a portfolio of properties that they'll use a third party Proptech or Proptech / estate agent company to manage. So I well see that as a big growing space. And also, if you do notice, the government just announced a build program. It's only a test program at the moment. I think they've only put 40 million in, but effectively what they do is they will underwrite up to 80% of the value of the loan, a bit like CBILS, but so effectively the profit is at risk. But effectively they've got step-in rights. So they've started this whole scheme to get SME developers building again, because that's what they've been talking about for years. But in reality, what they're kind of doing is just getting SME developers to build houses for them, with the hope to take it, I imagine, to put it into these ISA portfolios. I mean, I could completely wrong, could be adding all the points up and getting to a ridiculous outcome, but I think it's been the natural progression of what the government have been talking about for the last 4 years.
Indeed. That's been brilliant, Toby. Thank you so much. You covered so much, and that's what I love about talking to you. You can speak on such a plethora of topics and subjects within the property space.
Thank you so much. You're always too kind, Helen. You always make me blush. Put some skin in my unhealthy face today. But sorry, I'm a little bit under the weather. But I would like to point out, I also think 2021 is the rise of React funds, real estate and computer technology funds. I think there's so much competition out there. There's so many institutional and family office players out there. I think the small SME developers or SME property investors are going to find it increasingly hard to take that step from single unit refurbs and portfolios up, because I think the micro funds, small funds, asset managers are going to start looking at blocks of 10 units or above, where traditionally they look sort of 50 and above. So I think the ability to make quick informed investment decisions and then also use technology to manage, maintain and provide user experience for housing. I think technology is going to play, if it hasn't already, if 2020 wasn't already the year of PropTech, with everybody starting to use it for desktop valuations and stuff now, the likes of Sprift and Land Insight, I think this year going forward, the technology, this property management technology and the deal sourcing abilities of tech, I think are just the amount of people who's contacting me now, like, other established funds, like, how do we get your technology? It's like, you spend 5 years building it, mate. But it is, I think the likes of the algorithm-driven funds and technology-driven management are going to really come to the front this year.
I'm very excited about that for you as well. So you're perfectly positioned, and like you say, that's not been an overnight thing at all. But so watch this space indeed. Thank you so much for your time, Toby. Best of luck for 2021, and we'll meet back here in 2022 and see how it went.
You too, Helen. You too.